hello and welcome to the Property Trio. I'm rapt to be here with my two co-hosts, and today we've got a really exciting app because we're tackling two listener questions. But before we do that, how are you both going?
I'm
Smashing.
going really well, thanks, Kate. And
Great.
Annabelle just had her first day of school, so I walked her in with
Oh,
Sarah, gave her a big cuddle. She gave me a big cuddle, which is always nice, and
that's beautiful.
sent her off. So, yeah, that's an exciting day, having all three kids at primary school.
Yeah,
Sarah
and did
and
she
I
just go?
high-fiving.
You would be. That's long lunch city now. And did Annabelle find her friends and go straight to her desk?
Look, I didn't walk right into the school because I had to come back for the podcast, but yeah, I'm not sure. Sarah was hanging around because the preppies start a little bit later.
Yeah. Well, third child in though, I bet she didn't cry.
No, she's bouncing her way into school.
Oh, very cool. And you're good, Mike?
I'm doing good. I'm fired up for this episode. It should be fun, and yeah, hopefully we get some positive reviews at the end, as distinct from our Perth episode, which has been a little bit contentious. But I think it's worth saying. We were saying Perth has been smashing it. It's outperformed everywhere, and it's very likely to outperform in 2024. But it's just a bit of a cautionary tale when you're buying in such a heated market. So yeah, look, I hope that our long-term listeners appreciate that, and the one or two unsubscribers realise, our heart's in the right place.
Yeah. Yeah, you can't win them all, and sometimes popular opinion isn't necessarily what we'll cite, and Perth is just one of those topics that we covered where we all spoke openly and honestly and tried to gather as many facts as we could, but we can't guarantee that we have all of the answers either. So in a couple of years, when Perth is thriving and we were wrong, we'll do an episode on it.
Well, I think, look, at the end of the day, if we put it in perspective, we've been going for nearly 5 years, and it's the first two 1-stars we got in that whole time. The first two people have ever said they're going to unsubscribe. So I think we can deal with it.
Yeah.
The day's young, Dave. Let's see what we can get today.
I don't want Mike saying challenge accepted. Okay.
I bet you we get a spike in people re-listening to that episode now. So it's probably great marketing for that episode. I think, for what it's worth, it was a really good episode.
You two are too funny. All right, we're taking an awesome question from Catherine, and I'll read it out. My husband, 39, and I, 32, are doing well financially and trying to decide our next move. Our goal is to pay off our mortgage, but we feel like maybe we should be buying an investment property. We're in the South Australian western suburbs. Our house is worth around $900,000 and our mortgage is sitting at $290,000. We have a spare $3,000 a month after bills and allowances that we're putting onto our mortgage. If we buy an investment property, it will be negatively geared, but we aren't sure whether it's worth buying now, as we'll have to contribute to repayments. To buy a house with some land in a decent area is around the $600,000 to $700,000 mark. Will the tax deductions be worth it, or should we wait and keep smashing our mortgage and pay it off in 5 years? Thank you. This one, I said to the guys straight away, no brainer. Let's do this one, because I think we could all be able to add a little bit of intel to this, but I think we're all similarly aligned as well. Dave, I'll start with you.
Well, look, I mean, I think firstly, it seems to sort of be referencing, will the tax deductions be worth it? And really, you're buying the investment property for its investment return. And that is its capital growth, to grow your net asset position, and the rental return, which should grow over time and hopefully help fund your retirement. So, that's the starting point to make sure you're focusing on the right outcomes. I think in this country, there's so much talk about negative gearing that people lose sight of, why you invest in property. At the end of the day, a negatively geared property or any kind of asset means you're losing money on the cash flow. So that's not why you do it. You do get some tax deductions, but ultimately every single good investment, you should want it to be positively geared at some point down the track. So First of all, I just thought I'd tackle that. And then I might hand it back to Mike. But we've actually run some numbers, which I can then take our listeners through.
Great. Mike.
Love that. Look, I think it's interesting when they make the comment, our goal is to pay off the mortgage on the home. And it makes me sort of want to probe that. Why is that the goal? And fair enough, at some point in time you want to pay that off, but why in a short time horizon? They're very, very young. They've got, potentially 20 years worth of investing that they could do before they necessarily need to do that. I think it's a bit of an old world notion, and I think it's probably something that their parents' generation would instill in them, that you really should pay off the mortgage. But really, you've only got one asset that's growing in value, and you've got the opportunity to quite easily, subject to a strategic mortgage broker, go and buy two, and then suddenly you've got leveraged access to the overall growth of three properties all at once. I don't think you have to buy a negatively geared property. You could adjust your loan to value ratio to make it positively geared. But look, I think at the point in time where you're at, a negatively geared property is not a bad thing if the growth is there. When we say negatively geared, we go, okay, well, we're getting X amount in rent and the expenses are that minus something else. So we're in a loss position, but we don't consider the change in the value of the asset over time, because we don't get that until we sell or we revalue, right? So if that property's going up at 6 or 7%, at the end of the year, it's probably not a negatively geared property. And I think Dave is right. As the resident tax nerd, I always say, like, I hate tax, but I love what I do in the tax world. Tax is a bonus. It should never be the sole reason for purchasing something. So I would get the idea of tax and tax benefits out of your head. It's simply about, what do you want your life to be at retirement? And I think just focusing on that home, yes, you could get to the point where that grows in value and you could sell down and downsize and have some extra capital. But really, you've got so much time and capacity to be building a portfolio that is really going to blow the socks off any superannuation that you can build in that time. So it's easy for us to say because of the industry that we're in, but I think across the board, it's 100%. Forget paying down that property at the point in time you're at now, and invest in a good location.
I love this. I'm going to chime in as well before I go to Dave for the scenario, which I think is quite a powerful illustration. But the first message I'd have for Catherine and her husband is, where do you want to be financially, and what age do you want to slow down or have choice with your work or fully retire? Because if paying down your mortgage and then cruising is where you want to be, and you've got enough nest egg or you've got enough other investments in other asset classes to enable a really nice retirement, then maybe you can stick to your plan and pay down your mortgage and not worry about property. But if you're looking at property as a potential wealth creation opportunity, then the opportunity is now. And I look at your ages, you're both very young comparatively. I talk to people that are nearing retirement or 60 and wanting to get started with investing. You've got a lot of time. You've got a lot of surplus, and you can sustain a cash flow loss for the short term while your property grows in value and grows in rent. And I think it would be amazing for you to model out what it could look like with one or even two properties in your portfolio and what retirement would look like. And I think that the biggest challenge for you both is understanding the difference between good debt and bad debt. People who want to pay down their home quickly and give up investing in order to hold that title and know that they have no debt, the debt aversion is really high, and often they don't understand the difference between good debt and bad debt.
Yeah. And look,
Love
this
that.
is subjective, isn't it? So the point at which you're comfortable to what level of debt you have, what amount of surplus cash flow you have for when you're willing to go and invest into, buy that investment property, it's unique to each individual. So that is one of the tricky elements to it is, am I happy to do it when my debt's $290,000 and my surplus cash flow is $3,000 a month like these guys, or am I happy to do it when it's debt's 200,000 and my surplus cash flow is 4,000. This is a subjective thing. So ultimately, you've got to do what you're comfortable with. And, in terms of like working out the price point that is acceptable for you, like I've said many times, the key parameters is how much surplus cash flow would you like to still have after you buy the investment property? Because that ultimately drives your purchase price. And we can work that out with software so that we have. So you've got 3,000 per month surplus. You might be comfortable to bring that down to 1,000, invest 2,000 into the property. But what Michael from our property planning team has just actually ran the scenario of on the long-term property planning software, so not the next purchase software that we have. And basically what he's done is he's assumed growth on the principal place of residence of 5%, growth on the investment of 4%. So we're being pretty conservative. Yield on the investment of 4%, holding costs of 1.5% up front, and that's growing at 3% per annum with inflation, an interest rate of 6.5% and a tax rate of 37%. And just without getting, like, there's a fair few numbers, but without getting in the nuts and bolts of it, long story short, you end up about $500,000 better off in your net asset position. So factoring
At what age, Dave?
At what age? So I think that is from 20 or 30 years from today.
Right.
Yeah.
It's valuable and huge.
So it's a big number. Like sometimes it's bigger, and probably we're quite conservative with our modelling. So that is just buying an investment property today versus buying it in 5 years. Now, we don't have all their information. And obviously with the software, you can model out buying more than one investment property, etc. But ultimately, yeah, it's a $500,000 net asset position, superior net asset position in I think it was 30 years' time.
Amazing.
Do you guys remember, maybe early in your investing careers, the point where you're like, oh, okay, I had this salary for the year, this property went up this much. Wow, it's like I have two jobs and one of them I don't have to show up to. I want them to feel what that's like.
Well, you can't crystallize the gain if that's the way you look at it, though, because you'll replace your salary for 1 year and you'll pay CGT on it, and then you're back to square one. But it is nice watching your property earn a higher salary than you, knowing, though, that you can't crystallize it. You've got to sit there and wait for it to mature.
Yeah. For me, I think it was more that growing that net asset position and seeing the debt become relatively low compared to the value of the assets was pretty exciting.
My most exciting was probably once our portfolio flicked over to positively geared. Obviously, we're paying tax, but I think when you're paying tax, it's for a good reason. It's because you're earning money off your portfolio. And I remember noting after tax and expenses when the income was matching my first salary out of uni, and then my second salary, and so on. And you watch this income grow, and I can't speak highly enough about the power of compounding growth. And, we don't call it the eighth wonder for no reason, but that's the thrill. And it takes a while of sitting it out for most property investors, because a property in a metro area often won't flick over and get to that neutrally geared position until after 10 years. Maybe in a region you'll be able to do it in 5 to 10, but in some busy capitals, you're waiting 15 years for that to happen. But once it does, that's when it's a real game changer.
So the message is model it out and see it on paper, I think, and then you can really start to understand how this decision could have such a big impact over the long term.
Yeah,
absolutely.
And how it could open up and lead to other decisions and opportunities as well.
Yeah. So, Catherine, I hope that's helped you and given you a little bit of a steer in the direction of maybe a planner, so that you can have a bit of a chat about what it could look like and look at the numbers first so that you've got familiarity. And thank you so much for your lovely comments and for writing in. Our next listener question is another question from Leonard. Leonard, you are keeping us on our toes, and I love it. So I I was pondering the land to asset ratio metric as a measure of investment grade property, and I think it warrants more consideration. I'd love to know your thoughts, but my musings are below. So, Dave and Mike, what Leonard's done is given me quite a few things for us to ponder. So he's essentially written our show notes questions for us. Thanks very much, Leonard. You've made it easy.
It's quite a muse.
It is. So I'm going to run it past you because, as Leonard points out, it does warrant more consideration because land to asset ratio is only one measure of investment grade, and we need to use it in tandem. On its own, it doesn't give you the answer. I think it's one of the more potent ones, but it's not one measure. It's one rule of thumb out of many. If more land is better, then that would imply buying vacant land would be a superior investment than buying something with a dwelling on top. Mike, I'm throwing this one to you.
Well, like, we've never said, as far as I'm aware, that everyone should invest in farms because there's a lot of land, right? And you know, farms that perhaps have no allowance for a dwelling to be built, right? Because a dwelling, you know, if you take it to the obvious farcical conclusion, land to asset ratio, let's just have it all land, right? Because land's appreciate and building depreciates. But it's a bit like the difference between, say, silver bullion, which I've brought up before on this show for weird reasons, and let's say a stock on the ASX. Silver bullion really can just go up or down, but it doesn't provide anything along the way. It doesn't kind of service its costs. It doesn't provide you a yield, whereas stocks on the ASX will likely give you dividends. And now that varies on what sort of thing it is. But a house on a block of land is important because that is the income producing part that helps you to service the repayments, right? Because a bit like in Catherine's question, where we were talking about, well, you can't really crystallize that gain until you sell the property, but the asset is kind of growing. Yes, land will do that, but without something that produces income on the property, it's sort of almost impossible to hold on to that. It would be so negatively geared that it would destroy the rest of your borrowing capacity, quite likely, and then you're just left with something that you hope will grow in time. So I think you can take it a little bit too literal. I think when I first heard about this concept, which it was probably on the podcast that you guys were doing with Pete, it was kind of like, all right, well, it is quite intuitive that if you have a bigger parcel of land, then you're owning limited monopoly squares on the board, right? That's what's really driving the prices up. And it's not the same if it's a farm, or it's not the same if it's a region. It's not the same if it's 1 kilometre from the CBD or 15 kilometres. So there's no hard and fast rule to it to me. So you can get a little bit too analytical with it. You can get a little bit too ridiculous. I think the main point is the greater proportion of land that you can buy within reason, it's more likely to be a better performing asset.
Yeah, and one thing that we haven't touched on with vacant land is there's no tax deductions.
Yeah, well, we did actually touch on it in episode 16, but we're touching it on again. There are no tax deductions with vacant land. So there isn't even any gearing if you purchase a vacant land. So that's a really important point as well. And as per everything Mike has just said, yield and income is a really important part of pretty much all great assets, whether it's in a business or a share or a property. There's not too many assets, and obviously people who are into cryptocurrencies might argue this, and gold and what have you, and silver bullion, but you're missing out on something if you're not getting a rental return or a yield off an asset, and that's certainly the case with land.
And let's talk about this. I've used rough percentages when it comes to this measure before. And, land, it's 100% land to asset ratio. A horrible house that you can't rent out that will cost money to remove that needs to be removed, you might be sitting on a 105% land to asset ratio. And you've got to decide what your tenant experience looks like when you're wanting to get into that really high measure. I can go and buy someone a 98% land to asset ratio property, but their phone will ring a lot and they'll probably not meet the minimum rental standards. So there's other types of headaches. And to Mike's point, when we're looking at this question and saying, well, why wouldn't we recommend people go on land bank? Because most people can't afford the holding costs, and you've got three returns you need to be mindful of, not just capital growth. The reason why land to asset ratio is so valuable, though, is capital growth is generally the largest component of your three returns that you can get out of property. So first and foremost, you've got capital growth, then you've got rental returns, and then somewhere in the mix, you've got tax returns.
Yeah.
And the tax returns are just a bonus. They're not a reason to do it, but they certainly make a difference.
Yeah, and there's been international research that I've read that says 80% of the growth in residential property values comes from the land.
And we should talk about the tax side of things as well. And I just sort of thought, oh gosh, I don't want someone to write into the comments, yeah, but you can adjust out your farm and put cows on it and it could be income producing. We're just assuming this is a ridiculous
yeah. Bring it back to residential.
I'm just horrified by these 1-star
let's move on.
iTunes reviews. But we hear the old adage that land appreciates and building depreciates, and from a pure tax point of view, a building essentially has a 40-year maximum effective life, not from when you buy it, from its date of construction. Now there would probably be a third of all properties in Australia. This is a guess based on our research that says about 69.9%. I say about, that's exact. 69.9% of properties are built after 1987, which is the cutoff date for original building structure deductions. So let's say about a third of
changing all the time.
It does, yeah. If I crunch it tomorrow, it'll be different. We do have a live dashboard that sometimes I sit and muse over, which Leonard hopefully will appreciate.
It's actually a really good correlator. I'll just be really quick with land to asset ratio, because I think one of the things, it's not a static number.
Right.
It's not static. I think that's something we should sort of build on. But sorry, you keep going.
Yeah. With the land appreciating and the building depreciating, I mean, on paper, the building depreciates, right? But we could be contracted to do a tax depreciation schedule on a property and that we come to the conclusion that there is actually no depreciable value in the building. You'll get no deductions. Let's say it was built in the 1970s and has never been touched. In fact, we were engaged to prepare a depreciation schedule on a place in Vaucluse pre-COVID that was purchased for $8 million. And you kind of think, all right, well, there's going to be some good deductions in that. And I've even heard quantity surveyors, they shouldn't say this, but have said, normally you get about 60% of the purchase price in depreciation. Now, this person paid $8 million, so they're kind of thinking, well, it'll be some good deductions. And I had the unfortunate honor of saying 0 deductions. I mean, this is a very unusual place that was kind of uninhabitable, right? You could rent it out, but it wasn't really the highest and best use. So on paper, the building had no value, right? But you probably could have put someone in that property, and in Vaucluse, honestly, you probably could have got $1,000 a week out of it. So just because on paper it has no value, it doesn't mean it doesn't have a utility value. So a residual depreciation value is not the same as a utility or a market value. I think that's an important point to make as well.
Yeah, no, really valuable. I'm going to keep us moving. Dave, this one's for you. The metric also implies that $1 million worth of land in the middle of the desert is of the same quality as $1 million of land in an infill blue chip suburb.
Yeah, so I think, again, it's similar to what we've just been talking about. If we think of like an inner eastern suburb of Melbourne or Sydney, $1 million might get you 200 square metres. Whereas in a desert, it might get you 200 square kilometres. Okay. So, firstly, the value of the land is significantly different, okay, from a desert to the most sought after location.
Well, the value is the same at day one. You buy $1 million worth of dirt in the desert and $1 million 60 square metre block of land in the eastern suburbs. They're both worth $1 million, but in 10 years' time, they're not both worth $1 million. That's the point. So this measure, when it's like for like, it's a very valuable measure, because if I went into downtown Camberwell and I bought $1 million worth of vacant site and $1 million villa unit, well, the vacant site will go way more than the villa unit will. So it's like for like when you're looking at using it to project where a property's growth could go, because you're looking at the component of land in the same suburb with the same land value.
Yeah. So exactly. So the starting point is a land value per square meter is significantly different, but then where does it go? And that's the tricky thing to ascertain when Leonard's trying to wrap his head around land to asset ratio. But a great example is like thinking of, say, period homes in, say, Ballarat, and then say in Hawthorne. Now, when they were built, say 100 years ago or 120 years ago or 80 years ago, the value was very similar. Okay, but the price you're paying now for one, it might be on 1,000 square meters or a beautiful Federation home or something, you might be looking at $8 million versus $1.5 million, or, and that's sort of the correlation we're trying to help Leonard and our listeners understand is, how that value changes over the longer term.
Yeah.
Could there be uranium in this desert block? Now that no, I just knew that I was going to derail.
Yes.
I knew that was going to derail
How
it
much
and
is he
upset you
willing to
both.
invest in building a mine and getting all the equipment?
But I think
putting stuff.
I think to summarize sort of both your points, it only kind of works when you're comparing sort of like for like, right? You're looking at property A versus property B, and they're in the same local government area. You can't you can't go to realestate.com and go, what's the maximum land asset ratio, and then go, all right, search criteria Australia, go, I'm going to pick the number one, because you will end up with desert dirt, right? And that's not going to perform. And as Kate said, this is just one metric amongst a bunch of them, and it can be used to differentiate once you've zeroed in on a location. It's not a principle that you can go, I'm just going to find the highest land to asset ratio as my golden metric. It's a recipe for disaster.
Yeah. And look, as a buyer's advocate, I'm probably guilty of using this terminology a lot. But if you step into my shoes, and just to give a little bit of insight behind the scenes at my desk, I'm often working with one client in one area. And when we're comparing properties, land to asset ratio comes up a lot, because they might find something glossier and newer. And I'm saying, yes, it's great. And you'll get a really great tenant and a great return. But if you're looking at the proportion of the property that is a portion to the dwelling, and then the rest is to the land. If we're looking at a new townhouse on 120 square metres and comparing it to the older house on 400 square metres, the older house will do better from a capital growth point of view. And you've just got to keep your returns separate in your head. You've got rental return and you've got capital growth return. You can't confuse the two.
Yeah.
Dave, I've got a question for you. When a property transacts, how do you even assign a value attributed to the land versus the dwelling?
Yeah. So look, ultimately you need to, again, understand the value of land per square meter. Now, again, like that's subjective, but you
Yeah.
can get a sense of the land value per square meter. Now, many real estate agents actually publish that information on their sales materials that they send out, and they'll say, look, we've sold 30 properties in this suburb. Average land value per square meter is this over the last month or 6 months or 12 months. So you can get it from agents. You can track your own comparable sales and figure it out for yourself. There are some data providers that will also provide you with land value per square meter estimates. And so ultimately, once you figure that out, you then have an estimate of the value of the land, and then you can also get skilled at estimating the value of the dwelling that sits on top. And ultimately, that's actually how valuers break up every single one of their valuations. They assign a value to the land and then a value to the dwelling. So that's how you can go about it. You need to invest a little bit of time or speak to local agents, but you can certainly assign a value of land per square meter. If you know the size of the land, you then know the size of the land that property sits on. But you've also got to understand that, one side of the street, subject to orientation, for example, can have a higher land value per square meter than another, or one part of the street that's, got views of the city, whereas a lower part of the street doesn't. One part of the street is more prone, has a flooding overlay because it's lower down. I mean, these are all things that exist just in the streets around where we live. So you actually do have different land values per square metre, from street to street, streets next door to each other, but also within the street. But you can get an estimate of that value yourself. But you've also got to understand that everything is subjective. I mean, ultimately, it's driven by what people are willing to pay for any certain given property. This isn't an exact science.
Yeah, very, very true. Okay, we've got an example here that we need to explain. If a property transacts for $1 million, assuming fair value based on all comparables, let's say there was a reliable way of attributing value to the land at $600,000 and the dwelling at $400,000. If all else were equal and an identical property B sells to a more emotional buyer who overpays an amount of $1.2 million, how is the additional $200,000 emotional value attributed to the land and dwelling? Now, I saw this and I thought, well, the property's still worth $1 million. And if someone pays 1.2, they've got to reconcile that with the lender when the valuation comes in short. But at the end of the day, that's a reflection of blue chip aspirational buying. And it's a fine example of it. And the thing about some of these blue chip areas and beautiful properties that are much older and they're very individual, they've had decades and decades of iterations and changes. So they're not like a cookie cut example of, a house in the same street. Buyers find it very difficult to put a value on a property like that. How do you value something that's scarce and almost perfect? And that is where you'll see people paying extra, and it's why a lot of people will recommend a beautiful period house that has all of the great attributes, because you will see buyers potentially overpay. And if there's a lot of buyers and an undersupply, you'll continue to see that chain reaction happen. But at the end of the day, valuation is valuation. If everyone is thinking the property is now worth $1.2 million, then it's sustained capital growth and the old valuation is no longer necessary. I hope that makes sense. Would you both agree with that explanation?
Yeah, 100%.
Sorry, Dave, after you.
There you go.
I want what Leonard's having. I don't know if it's a type of Shiraz or Cabernet or whatever it is. I like the way he's teasing this apart, but at the end of the day, you've got to say, well, what is the real question, and does it? How much does it actually matter? Because there's a number of ways that a property can be valued, and let's say this one goes for a little bit more. Well, do we assign the value to the dwelling, or do we assign the value to the land? A valuer will normally use three possible methods. One, and the one that they love, is comparable sales. That's the obvious one. Summation is what Dave spoke about. It's kind of like, all right, well, here is the value of the land, here is the value of the dwellings, and valuers are very limited in their ability to put an accurate value on the dwelling. You need a quantity surveyor to do that accurately, and I'm sorry to toot my own horn, but that's just the way that it is. And then the other part is based on the cash flows, right? So it goes all the way into commercial vals where you're looking at discounted cash flows and internal rates of return. But you can come up with different numbers. So the depreciable value of the dwelling might be $100,000. The rebuild cost might be $800,000, but in a summation valuation, it might only be $400,000. But kind of what does that even matter if you're just trying to buy a good quality asset that grows in value over time? Also, the valuer general that puts a valuation on the land will give you a land value, but is that a market value? So if you rip the house off and you cleared the site, would you sell it for that land value? Almost certainly not. They tend to be much more conservative than what the value would be. So I think
and they don't do them all that often, which is why they're often dated.
Yeah, exactly. And the people that complain, oh, my land valuation's gone up, I always kind of say, well, like, would you sell it for that? Or like, no, it's like a couple of $100,000 under what it's worth. I'm like, well, maybe just don't get too upset then, because it's gone up, but it's still way below. I think you can get in the weeds so much that you lose orientation. When I did my scuba diving course, I had quite a lot of experience in that going through the weeds in zero visibility, looking at a compass. You start looking at the weeds or taking your eye off what you're doing, you get lost and confused. And I think like a lot of this discussion could really get people lost and confused. So I think you can overanalyze this, and in that situation it's just kind of like, okay, well, it's what are people prepared to pay for it, and does that heat stay in there? And someone that's maybe overpaying today could be setting a floor or a comparable for a market tomorrow, right?
Mhm.
So you don't necessarily need to assign it to the land or the dwelling. It's the package, because you can't just sell the dwelling, you can't just sell the land and like keep the dwelling in place. It's a package deal.
Very much so. And let's delve into this one a little bit more, because we've sort of touched on it. Leonard's suggestion of the saying land appreciates and buildings depreciate is short-sighted. I think that's a fair call for some properties. And he said depreciation is merely an accounting concept, and it doesn't necessarily mean that something loses its value as it grows old. A heritage or character home with unique characteristics would surely be more valuable than a new cookie-cutter style apartment. Other examples, vintage wine, cars, antiques, etc. Spot on. So land to asset ratio is just one measure, but we also look at in period housing locations, we look at the scarcity element as well. And scarcity is an enormous part to selecting an asset for capital growth. And I think you'll both agree that, you know, a gorgeous old Georgian or Victorian or Edwardian or whatever it might be will have an inherent value. And you can't compare that to a modern house. So whenever I'm doing my appraising, if it's a period property, I've got to stick to that, and ideally stick to that exact era.
Mm.
Look, yeah, I mean, I think it's a simplistic statement, but the accounting concept exists because it's true. I mean, a new property is going to depreciate in value. That's the reality. I mean, the cost to build is much more than all the materials combined put together. I mean, that the materials might only be 50% of the cost of the dwelling. The remainder of the cost goes into the skilled labor, goes into the builder's margin,
Taxes.
taxes, significant taxes nowadays, which is actually one of the things that's really eating into the cost of building new homes.
It's another show.
It's a whole nother show, because
It is indeed.
that you know, we take so much tax actually from workers in Australia compared to most countries. So anyway, but that's a whole nother conversation. So the point, the dwellings are going backwards in value. We are able to claim depreciation on a dwelling, but it isn't linear like what you're able to claim but it does take place. And what people can struggle to reconcile is dwellings are being updated ad hoc on a regular basis, and often we don't see it. Every little minor or major renovation, new kitchen, new bathroom, this is all money that's gone back into that property extension that then changes the value of that dwelling. But it will keep going backwards in value if you do nothing to it. That is really what will happen. At some point, it will get to a zero value, or actually the point that it's dilapidated and unlivable, which so they do reduce in value unless people put effort into them. And I think it's important for Leonard and our listeners to actually understand that the dwelling does appreciate. There definitely can be a point in time where, because of due to the power of inflation, that the depreciation stops, because the build cost was, even if it be extreme, $1 or $2 million, but it depreciates down to, let's say, $400,000 or $500,000, because inflation then says, okay, even though it's pretty run down and you know not many people would be happy to live in it, it's not going to depreciate any further, because you couldn't even make anything like that for $400,000. So it will reach a point where it stops, as long as it's still livable. But if it's not looked after, it'll get to zero.
Absolutely. So the limitations to that statement that buildings depreciate is that ultimately scarcity and or inflation will kick into gear.
As long as there's a human looking after it to some degree. Otherwise, it will become dilapidated at some point. It might take 20 years, 40 years, depending on the quality of the build.
One last comment from Leonard. Let's say there was a block of land in a quiet, leafy suburb valued at $1 million. If for some reason council approved construction of a main road that cut through that suburb and would go through the frontage of the block, wouldn't you say that the value of the land has depreciated? How do you answer this one, Dave?
Look, absolutely, and therefore the land to asset ratio would change.
Yes, it would.
This is also important for Leonard listeners to understand is that land to asset ratio isn't a static thing. As we just explained, often dwellings are changing in value. If you just put a renovation in it, the value will increase. If it's untouched for 10 years, the value will decrease. Land values, because of inflation and also the amount of money that goes into any sort of particular area to live in, will change and go up. So land to asset ratios, you knock down a dilapidated house and you spend $1 million on a new house, the land to asset ratio changes as soon as that new dwelling's built. So it's a really important thing to understand. It's not static. And what's the right land to asset ratio for you comes down to your own personal investment drivers, which again sort of circles back to what you were saying at the start, Kate. I mean,
Yes.
How much rental return do you want? Do you want tenants living in a dwelling that's well looked after and suitable, so you don't have as many headaches? Or are you happy for them to live in a really rundown house where there are going to be lots of complaints and it's going to be a real pain for you, but you don't mind because you didn't pay much, when you purchased the property, because you didn't pay much for the dwelling, but you got into a great location. These are the decisions you need to make as an investor. And land to asset ratio sits on, a broad scale, and there's no perfect equation or number, but we can put broad brush strokes around like 60 to 80% is probably where you want to sort of land when you're buying an investment property as your land to asset ratio.
Excellent. Nicely said. Now we've got an express gold nugget each, because I really am putting on my Superman coat and going.
Now it's time for us to go mining for our gold nugget property tip of the day.
To Leonard's last point about a council change and a street going through a suburb, and all of a sudden your quiet block is now on the edge of a main road, that all comes down to due diligence. So your due diligence has to involve many other steps. It can't just rely on calculating land to asset ratio. If you've got compulsory acquisitions that you could be facing, or new freeway development or road widening or anything like that, you need to be doing that long before you sign a contract.
I think on that as well, Kate, and we'll call this my nugget, is depreciation is probably the wrong word if a bit of your block gets cut off. I just think the value dropped, because depreciation is really more about something galloping towards its functional obsolescence, as the ATO would call it. This is why I'm such a hit at parties, right? And depreciation is, I don't know if I'd agree necessarily as an accounting concept. Like it's tax legislation as written into the Income Tax Assessment Act of 1997, but it's a political beast, right? So, for example, you get higher depreciation if it's a brand new property than if you do you buy an established property, let's say if they're to the exact same standards. And these things can be manipulated by Treasury over time. The build to rent sector is getting higher rates of depreciation because we want them, right? So I think it's very problematic trying to assign a value to a home. And as a concept, it's just like if there are two blocks side by side, one has 3 villas, one has 10 apartments, you're going to have a higher percentage of that land if you own one of the villas than if you own the apartments. And the highest and best use of that block might be high-rise development in the future. And the net result is that having that higher percentage of land means that your property will be growing faster. I think it's a macro concept.
Mine's really brief. Land to asset ratio is just one factor when assessing the capital growth prospects of an investment property. And some of your statements have sort of said as if it's about assessing the value of the property, but it's just to be really clear, it's about assessing the future capital growth prospects of the property. And if you understand it fully, where we've discussed lots of different parts or connecting factors to land to asset ratio through this episode and our previous episode, number 16 on land to asset ratio, it will help you make a better investment decision overall.
On that note, I'll
Over
see
and
you guys
out.
You
next
need to
week.
go to Brunswick.
I gotta go. I'll see you later.
See you later. Bye.
Bye.